Hello, this is Alexander Green, Chief Investment Strategist with the Oxford Club. And today I want to talk to you about the outlook for the economy and the markets and what you should do as an investor. If you've been tuning in to these videos of mine, you know that I'm uh, thinking, as most investors are, that the outlook for the economy is terrific because the pandemic is receding and businesses are reopening, and the Federal Reserve is holding interest rates very low, which makes it cheaper for consumers and businesses and governments to borrow. And of course, we've all these stimulus payments and deficit spending. The federal government is helping to promote economic activity. And all those things are good for the market. There's only one thing that you need to be aware of, and that is everybody knows this already. I mean, everybody knows that the pandemic's receding and the economy is getting better and the outlook is good, and it's already reflected, already discounted in share prices. And so I'm mentioning this not to make you think that you should have negative thoughts about the market or to get out of the market, but to remind you that if you want to consider yourself a sophisticated investor, you have to hedge yourself for a couple of reasons. The first reason is there is no direct correlation between the economy and the stock market. That might seem odd at first, but remember, the stock market is a forward-looking indicator. And just like last year, when the pandemic was growing and businesses were shutting down and the economy was contracting, stocks did very well. It's going to shock some people to see the economy do well and stocks may very well do poorly. So there are things you can do now while the market is good to take advantage of choppier markets ahead. The first thing you want to do is look at your asset allocation. Your asset allocation refers to how you divide your portfolio up, not just among stocks, but large cap stocks and small cap stocks, in other words, large and small companies, growth stocks and value stocks, foreign stocks and domestic stocks. You should own them all. With bonds, you want to own high grade bonds, high yield bonds, sometimes called junk bonds, which the returns have not been terribly junky. They pretty much are on par with what equities have given over the years. And even in your portfolio, you should have a smattering of precious metal equities, in other words, companies that mine for gold, silver, and platinum, and real estate investment trusts. So that way you reduce your risk and have less volatility in your portfolio. Another thing you should do is to run trailing stops behind each of your positions. In other words, if you buy a stock at 20, if you want to use a 25% trailing stop as an example, and as the stock trends higher, you raise that stop to protect your profits. If the stock goes down instead of up, it protects your principal. So the good thing about stops is they give you unlimited upside potential with strictly limited downside risk. And it's just good to have a sell discipline. Otherwise, you're just hoping to know when to get out. And when is that going to be? When your big toe aches or someone rings a bell? You just don't know until you're looking in the rearview mirror when the market's going to peak or when the stocks you own are going to peak. So what do? You asset allocate your portfolio, as I just described, and you run trailing stops behind each of your individual stock positions. So I'll have more to say on these important subjects and others right here. So I encourage you to sign up, subscribe to the channel, and to sign up for my free investment letter, Liberty Through Wealth. And you can just click on the link below. Again, this is Alexander Green. Thanks so much for tuning in, and I'll talk to you again soon.